Europe, Eurozone. Price stability at last. Time to chill? A shopper pays with a €5 note for eggs at a market in Nice, France. Eurozone food prices have seen ups and downs, but overall inflation is finally near the ECB's target. For the first time in a long time, we can say this about Europe. Inflation is boringly on target. And that's fantastic news for personal finances across the Eurozone. In August, Eurozone inflation edged up to 2.1%, basically smack dab on the European Central Bank's ECB goal of around 2%. After years of both undershooting, remember the 2010s when inflation was comatose? And then the recent bout of overshooting, the 2022 spike when energy prices went bonkers, the ECB's price stability ship appears to be righting itself. Rare success is how Reuters termed it. Given the ECB had struggled with too low inflation pre-pandemic, then had to fight too high inflation post-pandemic, getting back to 2% feels like threading a needle. And yes, 2.1% is a touch above 2.0%, but we'll call that a rounding victory. Let's unpack the numbers a bit. The slight uptick from 2.0% in July to 2.1% in August was mainly due to unprocessed food prices rising and a smaller drag from energy. Energy costs had been a huge factor driving inflation down earlier in the year, as last year's sky-high gas-electric prices dropped out of the annual comparison. But by August, the energy price decline was less dramatic. Meanwhile, fresh food got pricier. Perhaps summer heat waves and droughts in parts of Europe hit some crops, raising produce prices. However, core inflation, stripping out food and energy, actually held steady, or even slowed slightly. Core was about 2.3% in August, above expectations. Economists thought it would dip to 2.2%, but still on a gentle downward path from earlier highs. In particular, services inflation eased to 3.1% from 3.2%, suggesting that wage growth and pent-up demand pressures are not running out of control. Goods inflation remained muted, thanks in part to cheaper supply inputs and that stronger euro making imports cheaper. All in all, these figures confirm the ECB's own projection that inflation will hover around target through year-end. It's a welcome stability, not too hot, not too cold. What central bankers dream of, perhaps while clutching their well-thumbed copies of Goldilocks and the Three Bears. Now, with inflation finally tamed, you might expect the ECB to be gung-ho about cutting interest rates to boost growth. Pump those brakes! Or rather, don't pump them yet. The ECB has already cut rates by a total of 2 percentage points since mid-2024, bringing the deposit rate down to 2.0% currently. They appear content to hold steady in the near term. Indeed, as the ECB's early September meeting on the 11th approached, markets overwhelmingly bet on no change, no hike, no cut. The mentality is, if it ain't broke, don't fix it. Inflation is at target. Why rush to stimulate and risk inflation flaring up again? Plus, the ECB just started cutting a few months ago. They probably want to see how the cuts filter through the economy. ECB President, currently Christine Lagarde, but rumor has it she's eyeing retirement soon, and her colleagues have been sending the vibe that they're in wait-and-see mode. That said, a debate is simmering under the surface at the ECB about future moves, sort of like a pot on low heat that could either simmer down or boil over later. On one side, you have the hawks, like board member Isabel Schnabel, who cautioned that risks to inflation might skew higher again. She argued there's no risk of inflation getting stuck below target given decent economic growth and things like trade turmoil possibly pushing costs up. Schnabel basically said, we can tolerate mild misses in either direction, but let's not get complacent. Translation, no hurry to cut much more, keep some powder dry. On the other side, you have doves who see room and need to ease policy next year because they fear the economy is too weak and inflation could even undershoot. Some economists think inflation might dip under 2% in 2026, albeit temporarily. If that happens, the ECB might consider an insurance cut, a small rate trim late this year or early next, to ensure inflation doesn't stay too low. Market pricing reflects this uncertainty. While hardly anyone expects a cut before December, by early 2026, rate cut odds rise above 50%. In fact, traders are wagering on at least one more cut by spring 2026, taking the deposit rate perhaps to 1.75%. Some analysts at ING even speculated a final dovish push could come if the US Fed resumes cutting rates. Because if the Fed cuts and the ECB doesn't, the euro could strengthen too much, hurting exports. So the ECB has one eye on inflation and one on the Fed, Imagine trying to cross your eyes like that. But that's central banking in an interconnected world for you. Now onto the real economy, which influences those policy debates. Eurozone growth is, in a word, sluggish. The latest data shows the bloc is skirting the line between expansion and contraction. The composite PMI, a survey of business activity, was barely above 50 in August at 51.0, signaling very modest growth. Manufacturing, long the troubled child, actually improved a bit. Strongest production increase in 3.5 years, believe it or not. But services, the larger part of the economy, slowed to a crawl with a PMI of 50.5. Some quip the Eurozone is like riding a bike very slowly, technically still moving forward, but at risk of toppling over. Indeed, a chief economist at Hamburg Commercial Bank used that exact analogy. Riding a bike too slowly can make you tip over. That's the risk facing the Eurozone. Yes, the economy has been growing, but the pace is painfully slow. Factors like political tensions, France's protests and Spain's electoral mess, and uncertainty over an EU-US trade deal don't help. Looking at countries, Spain is still the star performer in growth. Even it cooled a bit. Italy saw a slight pickup. Germany, the biggie, slowed to near stagnation, and France remained in mild contraction, though even France's PMI improved to just under 50. It's very much a north-south split. Southern economies rebounding from COVID tourism slumps are doing okay. The industrial powerhouse Germany, grappling with China's slowdown and high energy costs, is struggling. This weak growth backdrop is another reason the ECB isn't eager to keep rates high for long. The bloc can ill afford a too high interest straitjacket when it's barely growing. Notably, employment has held up, even accelerated to a 14-month high growth in August, thanks to hiring and services. Factories still shed jobs. So the labor market hasn't cracked yet. Unemployment in the Eurozone is around 6.4%, the lowest on record for the bloc. That provides some cushion. Employed people can spend and keep the economy afloat, and it also explains some resilience in consumer sentiment. Speaking of consumer sentiment, Europeans are feeling cautiously better now that the inflation dragon has been, mostly, slain. The European Commission's Consumer Confidence Index, which is negative when more people are pessimistic than optimistic, improved through the summer, though it's still below long-term averages. Households are less pessimistic about their finances than they were a year ago, unsurprisingly. Energy bills aren't giving heart attacks upon opening now, and wages are rising in nominal terms. For example, in Germany, big union wage deals have lifted pay by 5 to 6%, helping workers cope with past inflation. Retail sales, however, remain tepid, suggesting consumers are still careful. When inflation dropped to 2.1%, many probably felt a sense of relief, but they haven't suddenly started splurging. It's as if everyone is peeking out after a storm, happy the downpour ended but aware the ground is still wet and slippery. What about the euro in your pocket? The euro currency has been relatively strong, hovering around 1.08 to 110 USD of late. A strong euro helps ease import prices. One reason energy inflation is negative: oil is cheaper in euros if the euro is up. But it can hurt exporters. So far, it's been a Goldilocks scenario. The euro isn't too high to cripple industry and not too low to import inflation. It's one more reason the ECB is comfortable pausing. They wouldn't want to cut rates aggressively, sink the euro, and inadvertently import inflation via pricier imports. For the average European's personal finances, the situation has markedly improved compared to a year or two ago. Inflation at 2% means paychecks aren't being gobbled up by surging prices each month. The cost of staples like natural gas and electricity is way down from 2022, giving breathing room. For instance, many countries have seen utility bills fall or government price caps help out. Groceries are still pricier than pre-pandemic, but the pace of increase has slowed, and some items, like vegetables, even got cheaper versus last year's extreme spikes. With the ECB's rate cuts earlier, borrowing costs have eased a touch. Mortgage rates in many Euro countries have stabilized or even dipped slightly from their peaks. It varies, of course. In countries with mostly variable rate mortgages, e.g. Spain, households felt immediate relief from ECB cuts. In fixed rate markets, e.g. France, Germany, new loans got a bit cheaper, though past borrowers weren't as affected by the hikes to begin with. If you have euro-denominated debt, the worst of rate increases is likely behind you. However, one lingering cloud is that real wages after inflation, are only starting to recover. 2022 and early 2023 saw a substantial fall in real wages across Europe. People's earnings just didn't keep up with price explosions. That led to strikes and demands for catch-up raises, from German metal workers to French transit workers, etc. Now that inflation is low, those negotiated raises mean real incomes may finally rise again, heading into 2026. For consumers, that's huge. More spending power, perhaps some room to rebuild savings that got drained. Household savings rates had dipped as people coped with high prices, but we might see savings tick up again if folks feel more secure that prices are stable. With less fear of buy now because it'll be more expensive later, people might actually hold off on purchases or shop for deals, which ironically could keep inflation low, a virtuous cycle for price stability. A quick note on investment trends. European stock markets have been choppy. The Stoxx 600 Pan-European Index ended this week near a one-month low. The culprit? Rising bond yields, not just in the UK, but German bond yields too, made stocks look less attractive, and there's caution about slow growth. Sectors like European banks and utilities, which benefit from higher rates, initially did well, but now banks worry rate cuts could compress future profits. Still, European equities didn't have a dramatic crash or anything. It's more of a drift down amid global jitters. If you're invested in Europe, diversification remains key. The region's equities aren't in a boom by any means, but solid companies are adapting to this new normal of 2% inflation and moderate rates. Also, for those interested in European housing, rising mortgage rates in the last 18 months cooled many housing markets, especially frothy ones like Germany's, which saw its first price declines in years. Now, with rate hikes done, housing might stabilize. Don't expect a UK-style surge everywhere. Many European countries didn't have as severe an inventory crunch or as much speculative buying. But for example, Germany has seen rents surge due to a housing shortage even as purchase prices dipped. Renters there certainly feel the squeeze. Sweden had a sharper correction due to lots of variable rate mortgages. Sweden's central bank is separate from the ECB, but also dealing with inflation. It highlights that Europe is not monolithic, but the common thread is improved inflation outlook, giving hope that the worst for housing markets might be over. In a nutshell, Europe's personal finance climate is looking brighter. Price stability is back, which means planning a budget is a lot less like pinning Jell-O to the wall. If you're a European consumer, you can breathe easier that your grocery bill won't jump 10% in a month, and your utility bill isn't doubling year on year. If you're a borrower, the interest on your loans isn't likely to rise further and might actually fall in 2024. If you're a saver, interest rates on deposits finally rose during the ECB's hiking cycle and will remain decent, a far cry from the 0% savings rates of the 2010s. For retirees or cautious savers, that's welcome. You can park euros in a bank account or government bond and actually get a modest return now, roughly keeping up with inflation. Who knew, right? The key risk ahead is whether the economy can pick up steam without stoking inflation again. The ECB would love to see stronger growth, so unemployment stays low and incomes rise, just without igniting a new inflation spiral. They're attempting the fabled soft landing, much like the US Fed. Thus far, it's more of a soft quasi-stall. Not a crash, but not a vigorous forward momentum either. So keep an eye on those growth indicators. For now, though, the Eurozone might deserve a small toast, maybe with a nice French wine or German beer, both of which incidentally haven't risen too much in price this year, for achieving something that seemed distant not long ago: boringly normal inflation. Sometimes boring is beautiful. And if you're traveling to Europe or live there, you might notice something bizarre: prices on some restaurant menus or shops falling. It's not widespread, but some energy-intensive services lowered surcharges they had added during the energy crisis. Enjoy those tiny victories. You earned them after enduring the opposite for so long. Want more like this? Watch any full video next. Thanks for fueling our 4,000-hour goal, and do not forget to visit personalfinancetime.com.